Do you want to grow your wealth but unsure where to start? What if I told you there's a smart and proven way to build long-term wealth by investing wisely over time? Sounds like a plan, right? In today's video, we'll explore the top 5 investing rules for long-term wealth growth. These rules are designed to help you make your money work for you and grow steadily over the years. Even if you're new to investing, let's get started. 1. Divide your money into different places. The first rule to follow for long-term wealth growth is to diversify your investments. If you put all your money into one type of investment and it doesn't perform well, you risk losing a lot. But if you divide your money between different investments, you reduce that risk and give yourself more chances to grow wealth. You can start by putting some of your money in stocks, as they have the potential for high returns over the long term. Stocks grow as the companies they represent grow, and they can offer substantial gains over time. But remember, stocks can also go down in value, so you'll want to balance them out with safer investments. Bonds, for example, are a more stable investment. They may not provide the same growth as stocks, but they offer a steady income stream and are less risky. Real estate is another great option to consider. Real estate investments can appreciate over time, and they provide an opportunity for rental income. Adding mutual funds and exchange-traded funds, ETFs, to your portfolio helps to diversify further, as these funds hold a variety of assets, which spreads out the risk. For beginners, investing in low-cost index funds or ETFs is a simple way to get started. They allow you to invest in a broad market, reducing risk while still participating in the market's growth. You can start small, gradually adding more as you get comfortable with how investing works. The key is not to put all your eggs in one basket. Why does this work for long-term growth? Because over time, diversified investments help you weather market fluctuations. When one investment goes down, others may go up, balancing out the risk. This approach helps keep your money growing steadily, even if some investments don't perform as expected. 2. Think long-term. The second rule for building wealth is to think long-term. Markets are constantly going up and down, and it's easy to get caught up in short-term fluctuations. If you focus on the daily changes, it can lead to stress and poor decision-making. But by keeping your eyes on the long-term picture, you give your investments the best chance to grow. Long-term investing allows you to take advantage of compounding growth, which is one of the most powerful wealth-building tools available. Compounding means that your money starts earning returns, and then those returns start earning returns as well. Over time, this creates a snowball effect, and your wealth grows faster. Let's take an example. Imagine you invest $5,000 today, and you earn an average annual return of 7%. By the end of the first year, you'll have $5,350. The next year, you'll earn returns on $5,350, not just the original $5,000. As time goes on, your returns will keep growing and compounding, leading to larger and larger gains. The longer you invest, the greater the impact of compounding, which is why the earlier you start, the better. Additionally, thinking long-term helps combat inflation. While inflation can erode the value of your money over time, investing in assets that grow over the long term can help your money outpace inflation. The goal is to let your money grow faster than prices rise, ensuring that your wealth maintains its value and increases over time. By thinking long-term, you're allowing your investments to ride out the market's ups and downs. It's important to stay disciplined, resist the urge to make hasty decisions, and stick to your plan. The longer you can keep your money invested, the more it can work for you. 3. Have a clear plan and real goals. Before you start investing, it's crucial to have a clear plan and set real goals. This means knowing why you're investing and what you want to achieve. Are you saving for retirement? Want to buy a house? Or are you looking to build wealth for the future? Understanding your why will guide your investment decisions and help you stay on track. Start by setting a time frame for your investments. Do you need access to your money in 5 years? Or are you saving for retirement in 20? The longer your investment time frame, the more flexibility you have to weather market fluctuations. If you're investing for short-term goals, you may want to consider safer options like bonds or cash equivalents. But for long-term goals like retirement, you can take on a bit more risk with stocks, real estate, and other high-return assets. Set realistic goals based on your financial situation and risk tolerance. It's easy to get caught up in the excitement of high returns, but make sure your expectations are grounded in reality. Start small and increase your contributions as you get more comfortable with investing. It's also essential to stick to your plan, even when things get tough or markets go through rough patches. The most successful investors are those who stay focused on their long-term goals and don't let short-term volatility dictate their actions. Having a plan also includes understanding the tax implications of your investments. Long-term investments generally have favorable tax treatment, meaning you'll pay less in taxes on gains that you hold for over a year. By keeping your goals in mind and focusing on a long-term picture, you can make smarter investment choices that align with your financial objectives. 4. Know the risks and be ready for them. The fourth rule for successful long-term investing is to know the risks and be ready for them. Every investment carries some level of risk. While stocks have the potential for high returns, they also come with the possibility of significant losses. It's important to match your investments to your comfort level with risk. The key is understanding the risks of each investment and making sure they align with your risk tolerance and financial goals. Higher risk investments like individual stocks and cryptocurrencies can lead to bigger rewards, but they also come with greater chances of loss. On the other hand, safer investments like bonds or index funds may provide steady returns but offer less upside potential. Don't invest in something you don't understand. Take time to research each investment option and make sure you feel confident in your choices. Staying informed will help you make better decisions and avoid common mistakes. As markets go up and down, it's essential to remain calm and avoid panic selling. Emotional decisions can lead to losses, so make sure you approach investing with a clear, level-headed mindset. Another important aspect of managing risk is diversifying your investments. Spreading your money across different assets, like stocks, bonds, and real estate, reduces your exposure to any single investment's poor performance. This helps protect your wealth from large losses if one of your investments doesn't perform as expected. 5. Keep investing and check your progress. The fifth rule for long-term investing success is to keep investing regularly and track your progress. The best investors don't wait for the perfect time to invest. They just start and keep going. Even if the market is volatile, continue contributing to your investments each month. This strategy, known as dollar-cost averaging, allows you to invest the same amount regularly, regardless of market conditions. Why is this effective? Because it helps you avoid trying to time the market. If you only invested when the market was high, you might miss out on buying at lower prices during downturns. By investing consistently, you buy more shares when prices are low and fewer shares when prices are high, leading to a lower average cost over time. Make sure to check your investments regularly, but don't obsess over daily market changes. It's important to review your portfolio once or twice a year to ensure it's still aligned with your goals. If your goals or risk tolerance change, you may need to rebalance your portfolio. Rebalancing helps you maintain the right mix of assets and ensures that your investment strategy remains on track. Also, be patient. Long-term investing requires time and discipline. While you may not see huge returns in the short term, the compounding effect will build your wealth over time. By sticking to a regular investment plan and reviewing your progress periodically, you'll be well on your way to achieving financial success. There you have it, the top 5 investing rules for long-term wealth growth. These rules can help you build a strong foundation for your financial future and avoid common mistakes that could derail your progress. Remember, the key to successful investing is consistency, patience, and a clear plan. If you found this video helpful and are ready to start building your wealth, make sure to like, share, and subscribe for more financial tips. Let us know in the comments which rule you think will help you the most in your investment journey. Thanks for watching, and I'll see you in the next video.